market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome. This is The Pulse. I'm Guy Johnson in London. Happy New Year. Happy 2025. We've already got some action in some key asset classes that we are watching. China certainly front and centre this morning. The other area, though, that we are watching is European gas prices. It's about to get really cold. And therefore, this really is going to make a big difference. They've risen to their highest level since October 2023 on the first trading day of the year. The reason for this, Russian gas has now stopped flowing to Europe via Ukraine. Now, this has been a route that Russian gas has taken for over 5 decades. Yes, it continued during the Cold War, but it has now stopped. The stoppage will slash Russian revenue by around $6 billion a year and force Central European countries to source more expensive supplies from elsewhere. Priscilla Azevedo-Rocha joining us now on set. Good morning.
Hi, good morning.
We've had this conversation already this morning and talked about what is happening here. Basically, we've seen a transit deal that has lasted 5 decades coming to an end. We knew this was going to happen, though. Talk about the effects, talk about the impact, though, that this is going to have.
Right, so we knew this was going to happen. But the issue is that it happened at a very, very bad timing for Europe.
Yep.
As you mentioned just now, the weather is turning really cold. And the biggest challenge now is to keep stockpiling levels from falling. They have been depleting in the past 2 weeks to the lowest level since 2021, which means that energy usage is increasing. And with colder weather, we see more of this usage. It might not be a problem for this winter immediately, but if we come to the end of this winter with stockpiles very low, it will be very, very tricky for traders from April to start buying gas to stockpile for the next winter, when we're still waiting for most of the LNG projects to come online. So the market this year is looking very tight.
What does Russia do with the gas that would have been flowing through the pipelines?
Well, the gas remains in Siberia.
Right.
They are looking into other routes. They're looking into China, but the capacity is still not there. Russia has sent record levels of gas to China in 2024. It is increasing, but there's still a lot of gas under Siberia.
In terms of what comes next for European prices, do they continue to climb? You said this may not be a factor for this winter, but it probably is a factor going into next winter. The market is a discounting mechanism. It's going to look ahead. Should we just get used to higher gas prices?
It's looking like it, because Europe now is relying on global markets to replenish its storages, which means it has to compete with other places for LNG or for seaborne cargoes, right? So it means that whoever bids the highest gets the cargo. So if China has a very hot summer and it needs gas for air conditioning, they will be outbidding Europe. So Europe has to push the prices higher to attract energy from abroad. So this is very bad for consumers. This is bad for the industries, because over 2 years since the energy crisis, we're still struggling with very high prices.
Which countries does this affect the most? And how much Russian gas do we still use? Russia still exports LNG gas. Are we still using that here in Europe? So who uses the pipeline gas, i.e. who's been affected by this move? And who's still using LNG, shipped gas, the most? Right.
So Russia has been increasing LNG shipments to Europe, and this has been a Putin long-term ambition, and we've seen that coming to pass. It's going to ports in France, it's going to Spain, but pipeline gas was mostly delivered to Slovakia, to Austria, and to a certain extent to Hungary and Czech Republic. In those countries, they're landlocked, so they don't have the same access to the LNG that the ports of France, the ports of Spain are getting. So for them to get this LNG, to replace these pipeline flows that they've lost, they need to pay transit fees, which will be higher to European countries. Slovakia could access supplies from Germany, for example. But getting from a port in the Baltic Sea all the way through Slovakia would cost more than transiting through Ukraine.
Thank you very much indeed. It's going to be an interesting one to watch. Priscilla updating us on what has been happening here. The team will be all over this story as we work our way through 2025. Priscilla Azevedo-Rocha joining us on that story. Let's turn our attention to one of the big stories we've been watching over the last 24 hours. The FBI says it is investigating a suspected terrorist attack and hunting possible accomplices after a truck was deliberately driven into a crowd in New Orleans, killing at least 15 people. President Biden says police are looking into any possible link as well between the attack and an incident that took place in Las Vegas, which involved a Tesla Cybertruck explosion outside President-elect Donald Trump's hotel in the city.
We're tracking the explosion of a Cybertruck outside the Trump Hotel in Las Vegas. Law enforcement and the intelligence community are investigating this as well, including whether there's any possible connection with the attack in New Orleans. Thus far, there's nothing to report on that score at this time.
Let's bring in Bloomberg senior editor Bill Ferris to talk about this. Bill, what do we know about what has been happening here and the connections between these two events?
Well, we have a little bit more information about that attack in New Orleans that took place just after 3 a.m. local time. Police have identified a suspect in that, a 42-year-old Army veteran who died at the scene after an exchange of gunfire with police. They said in his vehicle was at least one other explosive device and a flag showing support for the Islamic State terrorist group. There's been some reports that his social media profile shows some support as well for extremist groups. And he's from Texas, and investigators are taking their search there. They're calling on the public to offer any tips or any information that could help determine if he had any accomplices or assistants in carrying out this attack that killed 15 people. In terms of the links to Las Vegas and that Cybertruck explosion outside the Trump Hotel there, investigators are being very cautious, saying there's, as you heard President Biden say, there's no clear evidence of a link. One thing that they do have in common is that both vehicles appear to have been rented on the app known as Turo. For those who don't use it, it's kind of like an Uber for people who want to rent out their own vehicles. That seems to be the link, but again, it's not clear that there's any connection between these two attacks.
What does it tell us, though, of the overall security situation in the United States as we head into the inauguration of Donald Trump?
Well, it is going to raise a lot of questions about how such a popular place like Bourbon Street in the French Quarter of New Orleans could be targeted. There is a report from the New York Times that some bollards that normally help protect that area were being replaced and weren't there. That's why there was a police vehicle there instead. But it is obviously always a crowded area in New Orleans. They were scheduled to host a major college football game and parade on Wednesday night. That got kicked to Thursday. We'll see, I'm sure, a very enhanced security presence there. But it also just raises questions about security in other major cities where crowds gather. And, of course, one place that will be is in 18 days in Washington, D.C. for President-elect Trump's inauguration. I'm sure there's a second look at security procedures there going forward now.
Bill, great stuff. Thank you for the update. We greatly appreciate it. Bloomberg's Bill Ferris on what has been happening in the United States. Coming up, we're going to talk about what is happening on the other side of the world. Chinese stocks posting their worst start to the year. Nearly a decade, investors are bracing for economic certainties this year. The Trump factor is certainly part of this discussion as well. We're going to discuss the outlook for Chinese investors and global investors into China next. This is Bloomberg.
I'm looking at 2025 being the year of the great pivot. And by that I mean I think China is likely to outperform the US.
Uncertainties abound. And I would say it is, I think, very important for China to tap the policy space more ambitious, more aggressively and effectively.
I'm a little bit concerned as to the durability of the Chinese consumer amidst some of these, a weakening external outlook as well.
What I'm looking for is a sudden jolt or one other sudden announcement with the emphasis on money in the pockets. That will really cheer me up.
The next 12 to 18 months in China for investors based in the U.S. could be a bumpy ride, but for investors who have 3- and 5-year and longer time horizons, then you have valuation on their side.
Some of our guests giving their outlook for China this year. A lot of uncertainty, I think, is probably something you can take away from that series of clips. Chinese stocks posting their worst start to the year in nearly a decade this morning. Weak economic data, the Caixin, certainly not pouring a great deal of good news onto the Chinese market, and maybe got a lot of bad news. We've got the prospect, of course, of US tariffs coming through. We're waiting for the 20th, the inauguration of Donald Trump. There's a lot going on. Erik Nelson, macro strategist at Wells Fargo, joining me around the table. What's your degree of certainty on the China outlook this year?
About as low as usual. To say very low.
Yeah.
I think what's unique about China is that the ingredients for recovery can be there. You just need fiscal to step up, and that's been the case for years, and we haven't seen it.
Yep.
Right. There's the rhetoric we've heard from China in the last few weeks has been better, but it still has not been matched with actual details, and certainly not with actual actions. So I can make a positive case for the China in 2025. It just has to have that fiscal piece there. So until we see that, we're not yet super optimistic, but I certainly can see an upside risk scenario.
Does China have to do something dramatic in order to deliver the kind of change that people are hoping for? At the moment, we seem to be doing everything very incrementally, very low-key, not creating waves. Is that something that at some point may have to come to an end, and waves need to be created, and big waves potentially at that?
Sure, yeah, it's a scale problem. The numbers, to your point, we're talking about here, 0.5% of GDP here, 1% of GDP there, spread out over this many years. You need direct action. It needs to be big, 5, 6, 7, maybe 10% of GDP.
So what does that look like? Is it a big devaluation? What macro effect will that have? Are they really capable of delivering big fiscal? If they're not capable of delivering big fiscal, what else is on the table?
I think devaluation is not the answer to China's ills. Right, and my concern is that will continue to be the lever they pull, because there's this never-ending...
So it is a risk?
It's a risk, yeah, absolutely, especially if you see escalation in tariffs from the U.S. side. China needs something to offset that. And there's been this continuous focus on the supply side, right? That's been the main focus. Until that changes to demand-side stimulus, I think there is fiscal space for China at the central government level. Yes, it's all kind of one big system, and the local governments are sort of backed up by the central government. I get that. But I think there is fiscal space. You know, the bond yields are telling that story. It needs to be demand focused, not supply focused.
If they went for the lever of a currency devaluation, how do you think Donald Trump would react to that?
Not well.
No.
Not well. Yeah. I mean, we know how he feels about the dollar. We know that, the whole thesis behind putting tariffs on China is to try and offset and sort of undo some of these imbalances between the U.S. and China. A devaluation is just going to put us back to square one.
So basically it would offset the tariffs. So potentially you would need more tariffs, or you would need to do something different.
Effectively, yeah.
Given all of that, how does this year play out? If you're sitting here, you're a PM, beginning of the year, trying to figure out what is going on. Those are really big tectonic plates you're talking about moving around here. How easy is it to deliver a clear idea at this point of what 2025 is going to look like?
Well, I think it's important to understand their starting point here. What does the U.S. economy look like going into this, right?
Yep.
I wouldn't say it's super strong, right? Manufacturing and construction are the two cyclical indicators, or parts of the economy that drive the U.S.
Yep.
Neither one looks particularly strong right now. Manufacturing's declined 3 months in a row. Construction's weak. That worries me a little bit. Not where I'm saying, there's a recession on the horizon in the next 3 months. But, you have these cyclical parts of the U.S. economy saying, if you get this kind of trade war escalation, dollar gets much stronger, you're pushing it into a already somewhat precarious U.S. economic outlook with some of these risks.
What you may end up happening in the kind of scenario that you're talking about is it's not super strong, but it's strong. The Fed doesn't need to do a great deal. Does it need to cut? Maybe a little bit, but not by much more. But you've also got a 10-year that's going up. The curve is steepening quite a lot. And last 3 months, I think the 10-year's up by, 75 bips or something like that. What happens if that trade continues?
That's a problem. And, the housing, like I mentioned, the housing market, construction market has already come under pressure. Mortgage rates creeping back up towards 7, 7.5, maybe even going back to 8 if you see this move keep going. That's a real problem, right? This is what drives the economy here, and is that, long end of the curve in large part in the residential sector. So that worries me. And to your point, the steepness, the bear steepening of the curve, very, very confusing and very sort of worrying. When a hawkish central bank comes through, like we had the Fed in the middle of December, the curve is not supposed to steepen, right? And the fact that the 10-year sold off more than the 2-year, that tells me something is not quite right here.
So does term premium get greater?
Could very well do. I mean, and you look at the dollar funding market, repo market, still under some pressure.
Yep.
And that, I think, is playing into this continued pressure on the long end of the curve. So it's not a particularly encouraging sort of plumbing situation within the U.S. repo and Treasury markets. And that is kind of lurking there in the background.
Heard from Christine Lagarde over the holidays on X talking about the fact it's pretty comfortable, 2%. We're going to get there. It's all going to be good. How big a challenge is the ECB going to have keeping inflation at 2%?
I think, yes, certainly a somewhat difficult time. I do think, though, for the ECB, that the problems are very much both on the growth and the inflation side. So inflation is still above target. It's kind of, services inflation is kind of sitting, too high. But growth is also looking a little bit, weaker. And Germany in particular, France is not doing particularly well. And employment markets there are starting to weaken. Now, this is not the flexible labor market in the U.S. where you're worried about mass unemployment. But, the ECB doesn't have a dual mandate, but they have to start worrying about the growth side as well.
And what does that mean? So we're going to hear a lot about gradual, do you think? Is the word of the year 2025 from the ECB's point of view gradual?
It is for now. I think that could certainly change. And I think the same can go for the Fed, frankly. We have more cuts for the Fed than what they penciled into their dots for 2025. Not much more, but, the central bank's getting more hawkish, ironically, could mean more cuts down the road.
Right, because in the near term you get the effect of
more
that
pressure
hawkishness coming
on
through.
Activity, exactly.
Okay, so we end up. So how big could the gap between across the Atlantic get? And what would that mean for euro dollar? We're at what, 103 now?
Yeah.
Upside downside risk on that? Like, have we priced in most of kind of what we know at the moment already into that 103, or is the downside risk to that 103 still there?
No, I think we priced in quite a bit of the risk. And you look at just in the last 2-3 weeks, some year-end sort of dislocations happening. Euro's trading much lower than where rate spreads have gone in the last 2-3 weeks. So maybe it's a little bit cheap to rates right now. I think what is key for me is what happens between the U.S. and China on trade, and also the U.S. and Europe on trade, right?
Yep.
We know the U.S. has just talked about German autos. So there can be more risk premium in euro dollar, and in the sense of we can go through parity if you see widespread tariffs put in place on Europe, on China. China devalues, like you mentioned. There's certainly lots of risks that can get us below parity, absolutely. But right now, as we sit here today, I think there's some room for maybe at least a tactical recovery into the inauguration.
In terms of this year, do you want to... We have run through a lot of risks here. Often we talk about risks at the beginning of the year. Some of them materialise, some of them don't. Does this year feel like a year in which more risks are going to materialise? There is going to be more volatility, and therefore, in many ways, I want to take less risk this year than maybe I took last year.
Certainly the conversation we're having with a lot of investors, right? It's been a fantastic 2 years for assets of all kinds.
Yeah.
And, the growth backdrop looks a little bit shakier than it did, the beginning of last year. And I also think that, geopolitics is less predictable by its inherent nature.
Yep.
And so much of the outlook rides in that this year. So I think there's a lot of caution out there going into this year.
It's going to be a fun year. Eric, nice to see you. Thanks for setting it up for us. Eric Nelson, macro strategist at Wells Fargo. Coming up, Citigroup and Bank of America are the latest US lenders to leave a global climate banking group. We'll have details next. This is Bloomberg. Bit of news in the banking sector. Citi and Bank of America are to leave a global climate banking group. They are the latest lenders to exit the net zero banking alliance. The bank's departure comes with Wall Street under pressure from Republican lawmakers to distance itself from industry groups that support reducing carbon emissions. The NZBA is part of the Glasgow Financial Alliance for Net Zero, which is co-chaired by Mark Carney, who is the chair of Bloomberg Inc., and Michael Bloomberg, who, of course, is the founder of Bloomberg LP, the parent company of Bloomberg News. As we digest that news, I want to take you to Seoul, where crowds of supporters are currently gathering outside the impeached Korean President Yoon's residence. The Constitutional Court in the country is set to decide whether he will be permanently ousted after being impeached for declaring martial law in December. We'll continue to monitor these pictures. This is Bloomberg. Good morning. Welcome. Day one, day two of the new year. This is The Pulse. I'm Guy Johnson in London. Let's update you with your top stories. European gas prices rise on the first trading day of the year as Russian supplies to Europe via Ukraine stop flowing, ending a nearly 50-year agreement. European stocks a little mixed. US futures a little more green at the start of the new year. Chinese shares, though, have seen their worst start to the year since 2016. Plus, the US investigates whether there are any links between a suspected terrorist attack in New Orleans that killed 15 people and a Cybertruck explosion outside the Trump Hotel in Las Vegas. OK, let's talk about the year ahead. Let's figure out what we should be expecting, what we should not be expecting. As ever, we are deluged with a series of reports which tell us what we should be looking for in the year ahead. Bloomberg has fantastically collated these and tried to figure out what the consensus actually looks like. Wall Street's expectations for the year ahead, normally defined by economic statistics, of course. We normally look for things like growth and inflation and what price-to-earnings multiples will ultimately look like. These are good. They're fantastic. I'm a big fan of these kinds of indicators. 2025 looks a little bit more touchy-feely, though, because we are going to be seeing the year, I suspect, dominated by one person, Donald Trump. His impending return to the White House hangs over almost every word of the key calls from financial institutions for 2025. Politics is a less precise science. Fortunately, Bloomberg, though, has been through all of these reports. Let's figure out what we should take away from them. And Justina Lee joins us around the table now with more. What is the key takeaway, apart from Trump?
Well, interestingly, it seems to be, more of the same. I mean, there's kind of this consensus across Wall Street that even after the incredible rally we've seen in U.S. stocks, you can expect more of that. U.S. exceptionalism, still put your money in the dollar in U.S. stocks. And I think that's really interesting because in the past we might see a bit more mean reversion in kind of these strategist calls. But at this point, they're kind of, I think maybe after the experience of the past few years, they're like, valuations are high. But at the end of the day, there seem to be good reasons for why you should still keep your money in U.S. stocks.
The problem with it is that basically portfolio managers keep trying to change things and keep getting burnt. And basically, therefore, the safe trade is to basically say things carry on as they are. But you get down to the bottom of the report that you compiled and you look at the risks. And I kind of read through the risks. One bank says the U.S. economy is too hot. One bank says the U.S. economy is going to cool. One bank says it's too hot. One bank says it's going to cool. One says the Fed's going to be cutting. Another one potentially says the Fed is going to be hiking. What's the degree of certainty? And is it higher or lower than it would normally be?
Well, I think that, the big question here, of course, is Donald Trump, because another consensus across these reports is that if we do get some degree of tariffs, they're going to be inflationary. They're going to be, negative for the U.S. economy. So it seems like people are expecting, the positive outcomes from tax cuts, from deregulation to outweigh those. But at the end of the day, I mean, if you really do get kind of tougher tariffs and, an immigration crackdown, I mean, the consensus is that is inflationary. So that probably means, less rate cuts for the Fed or even kind of a pause in this easing path. And that seems like bad news.
The equity market, the S&P has done 20% last couple of years. What is the consensus for next year? As rosy as it has been? Is it, you've been doing this a while, you've kind of got a sense of how the market's feeling about things. Are people convinced that we're going to see another 20% year?
Well, not so much. So people are expecting maybe lower returns than that. But another kind of interesting call out there is I guess that is more the valuation play, which is that are we going to see a rotation into small and mid caps because of U.S. deregulation or kind of into more of those value sectors? Now, that's something that strategists have been calling for a few years, and we haven't yet seen a sustained rotation.
We saw a bit of it at the end of last year, but it didn't stick.
Exactly. So
is there an expectation that it comes... The broadening market thesis has been around for a while, but the AI trade still comes... Do you think people are scared of stepping away from that? Because that's where the money has been made.
Yeah, and I think there's a sense that maybe it also reflects changes in the underlying economy. I mean, the tech world is winner takes all. And at the end of the day, I mean, these tech giants are kind of almost monopolies in what they do. They kind of combine many different businesses. They have great balance sheet strength. So it can feel like it's both a growth play, but also a defensive play. And I think that just makes them kind of almost safe investments, interestingly, to a lot of investors.
Is there a lesson that we can... Are people worried about expectations being too high? And the reason I ask this question is Novo Nordisk got battered at the back end of last year. It was a stock that kind of is the perfect example of this, a stock where expectations got very high, were delivered upon, and then a tiny chink in the armour, and the stock gets knocked down pretty hard. Like, are people expecting a lot of volatility around some of these big names? How bumpy a year is it going to be?
Yeah, I mean, that's a great point. I mean, Bank of America said the biggest tail risk out there is AI, and Magnificent Seven turns out to be a bubble. Of course, kind of the good news now is if you want to hedge, I mean, you have kind of bonds paying out pretty good rates. I mean, you have the volatility market still, pricing in pretty low volatility. So if you want to hedge via options, that's pretty cheap. And of course, if you want to buy into low expectations, Europe and the UK are always kind of your play there. So we do have a few calls saying, maybe Europe will surprise to the upside because the bar is pretty low for that.
I feel like I've heard that before, and it continues to disappoint. Justina, thank you very much indeed. We are going to continue to monitor these. I suspect the year is going to start on January the 20th when we get Donald Trump coming in, and we'll start to get a better idea of what this year is really going to look like. Bloomberg Intelligence has compiled a list of 50 companies that we should be watching this year. AI, exposure to China, some of the big themes that BI is watching. Tim Craighead, Director of Equity Research, joining me around the table. Let's talk about the year ahead. 2024 was a U.S. year. Is 2025 a U.S. year?
Well, it's the biggest market cap. It's the biggest percentage of those 50 companies that we have on our list. But that's just natural that you would expect. We do see better growth in the U.S. We do have a constructive view, broadly speaking, on the U.S. markets, if you look at, what Gina Martin Adams is thinking. But it is reasonable to consider those concerns that you've brought up. Momentum works fantastic until it doesn't. And we all know that stocks go through life cycles of value to growth to momentum. And momentum is fantastic until, as you mentioned with Novo, you have a slight disappointment. Even if it's a fantastic absolute number, the disappointment kills you if valuations are high. And that's one of those things you have to keep in mind.
In theory, we should see mean reversion. In theory, the markets that have been beaten up should bounce back. Europe, China. Is that the trade for this year? If you're looking to diversify, manage your risk, do you look at these other markets, or are you going to be punished as a PM for not just taking on board the US, sticking with the US? Why take the risk of moving money elsewhere?
Yeah, well, I mean, that is the $64,000 pound euro question. And I would agree with some of the commentators that you've had on the program this morning. You can't walk away from the U.S., but there's too many compelling opportunities, part of which is valuation driven abroad. If you can find ideas where there is a catalyst that you think, that you feel compelled, can change the market's mind.
So talk to me about China. What do you see there?
Yeah, so our view for 2024 and 23 was very much oriented towards the property crisis and risk. Our view this year is more constructive. We do think stimulus will come through. It has been incremental so far. We're waiting on a big bang. We think more will come. So China wealth flows out of property into other markets is a big deal. HSBC is a really interesting story, as is CITIC Security in China. Consumption, we do think, will come back. There's a number of Chinese consumer brands that are quite interesting, but there's also European plays into that. Remy Cointreau would be an example. Travel will continue to pick up. Airbus has a huge business in China. There are a lot of ways to play this and steer away from property.
Let's come back to Trump. Look at your 50 stocks and talk to me through the Trump effect on those stocks and how he, as president, is going to have an impact.
Yeah, so we would say, number one, tariffs are out there, as you've talked about. We don't think tariffs happen this year. We think it's more of a bluster. And it's a negotiating tactic. He loves a deal. And so we would agree with Bloomberg Economics. That's more of a late 25 or 26 issue. notwithstanding talk. So what do you focus on with China? You think about stimulus. And with Trump, you think about stimulus because of tax cuts and deregulation. Those things can happen very quickly. And there you've got any number of ideas that play into economic growth. Adecco is an employment story. Signify, the world's largest lighting company, has a big U.S. business to see housing starts, renovation, other things like that play through, along with, a number of core U.S. companies that range everything from Tapestry, which owns Coach, to Workday, which is an employment-related story in the software world. Emerson Electric is a big diversified industrial that's a play in the U.S. just from purely better economic activity that we think will likely come through.
It's going to be interesting to see what happens this year.
Yeah.
We will come back and look at this 50. Tim Craighead, Bloomberg Intelligence Director of Research. Thank you very much indeed. Coming up, we're going to have more of our recent interview with the Unilever CEO on his turnaround drive at the company and the possibility of higher trade tensions with Donald Trump in the White House. We will do that next. This is Bloomberg. Welcome back. Unilever began a turnaround drive back in 2023 with cost-cutting measures, including headcount reduction of more than 7,000 jobs. Its CEO, Hein Schumacher, recently spoke to Francine Lacqua about everything from consumer spending, premium demand, to the possibility of new trade tensions coming back as Donald Trump returns to the White House.
Yeah, I mean, tariffs and protection is always disruptive for businesses that operate globally, and I recognize that. But hey, if it's a reality, then it's a reality. I think what we have been doing over the last few years is, in general, after COVID, we have made our markets in general more self-sufficient. Right. So if you look at, for example, our China market, it's essentially self-sufficient. India, for sure, is. The US is mostly self-sufficient, with some imports though from Mexico, but that is not material to the group. It's not significant, and we have a fairly agile supply chain that, if the situation, if it comes to that point, that we could reallocate our production from those factories to other parts in our network and make the US probably even more self-sufficient. So, hey, we are adapting fast. We're agile. It's not of material impact to the group, but we're obviously watching it very, very closely.
I mean, does it influence your decision on where to cut jobs?
No, at this point it doesn't. No, we have made an announcement on a restructuring program that you're probably referring to in March. 7,500 people, because we felt that was for two reasons. One, we are making the organization ready for a Unilever without ice cream, and that needs to be a lighter organization. And we wanted to be ahead of that demerger and take measures now. So that was reason one. And reason number two, we have changed the structure. I talked to you about strategy and structure. We've changed the structure to be faster, to be able to scale these brands faster across the globe. And when you do that, you need to take the consequences that, hey, it can be a bit. We can be more efficient, and that's what that's what we're doing.
But you worry about unfair advantage for some of your competitors that are based in the US.
Yeah, our competitors. We are based in the US. The US is our biggest market.
But you're not headquartered there. So someone like Pepsi, do they have an advantage under Trump if he puts America first?
No, I don't think so. I think we have been in the US for decades. We can, it's our largest market. We have phenomenal US-centric brands. I talked about prestige beauty, but also brands in well-being, such as Liquid IV, such as Olly on the VMS side and on the well-being side. So, we are in many ways, in that market, we are an American company, and I believe that the US government has every interest to work with companies from overseas who are active in America to promote investment in North America, to care for jobs, to do the right thing for that market, and that's what we're doing.
So you also divested, of course, what you had in Russia. Maybe some of your US competitors won't have to going forward. Was it a mistake to get rid of it? Russia
was something that was a very difficult decision to make. I found that in my last 1.5 years, it was arguably the most difficult decision to make. But I did make it quite soon, in the sense that I wanted to create optionality for us to exit that market, and that was a tedious process. So it took us more than 12 to 14 months to come to that point that we were able to exit. And at some point in September, I felt I had the optionality on the table, and it was difficult, but I made the decision to go, not because of the war that's going on right now, but because I felt that the control on our business was coming down. I feel that ultimately, if you're a global company, you need to have control of your operations. We need to be able to review results. We need to be able to get the cash out of the country ultimately. We need to be able to make sure that we live up to potentially international sanctions. We need to be able to control our brands and where our brands travel. And that was something that I felt wasn't enough anymore. And I didn't see a window into the near future where we would regain that control. And that drove the decision to exit.
And talk to me about Ben & Jerry's. So the way that Ben & Jerry's was set up was also having an independent board. Will that still be the case going forward, given actually, a lot of the questions that you've just been telling me about?
Yeah. No, Ben & Jerry's has an independent board, and that independent board that looks after the social mission of Ben & Jerry's only. So it's not a board that looks at the business side of Ben & Jerry's, because that's what we do, but it looks after the social mission that's there. That was agreed at the time that Unilever acquired Ben & Jerry's. It's in the merger agreement, and we absolutely respect that merger agreement. And therefore, the new ice cream company that will be demerged will respect that merger agreement.
Is it tough when the politics gets into selling products?
I think, in the case of Ben & Jerry's, look, that brand, we acquired it, I think, at a sales level of 120 million or something like that, and we've grown it to a more than $1 billion brand. It's been growing very successfully, and part of the success of Ben & Jerry's is a social mission, and the way they speak out and the way they speak up, and as long as that fits, the brand, peace, love, and ice cream, I'm all for that. It's a wonderful thing to do. You need to be careful that, as a company, that you don't take political sides when that's not necessary. Sometimes that brings a certain tension, but I believe it's a healthy tension. They keep us on our toes, and it's a great brand. I love it, and I'm sure it will be successful going forward.
That was, of course, the Unilever chief executive, Hein Schumacher, speaking with Bloomberg's Francine Lacqua. Coming up, we're going to come back to what is happening with the central bank story in 2025. Christine Lagarde welcoming the new year, saying that the ECB's inflation target, 2%, remember, is in sight. We are going to look at what lies in store for the single currency over the year ahead. That is next. This is Bloomberg. Welcome back. So the ECB's president, Christine Lagarde, says the central bank's 2% inflation target is in sight. She spoke during a New Year's address in a video posted on X.
So we have a big, heavy agenda at the ECB. We have made significant progress in 24 in bringing down inflation, and hopefully 25 is the year when we are on target as expected and as planned in our strategy. Of course, we will continue our efforts to ensure that inflation stabilizes sustainably at that 2% medium-term target.
Stabilizing sustainably at 2%. Let's get more on the ECB's outlook and what inflation is going to look like within the Eurozone in 2025. Let's have a conversation with Bloomberg reporter Ollie Crook, who joins us out of Berlin. Ollie, growth and inflation, two big challenges for the ECB. What indications are there that the ECB can sustainably stick to that inflation target of 2%?
Well, listen, if you look at the forecast in terms of what we're sort of expecting going into 2025, when we look at the average rate of inflation in 2024 is about 2.4%. We're expecting that now, according to Bloomberg Intelligence, to come down to 1.5% 0.7%. That is basically right in the range where the ECB wants to see things going, and a lot of pressures are going in the direction that basically confirm what Lagarde is looking for. What that means in terms of the outlook, in terms of what we're expecting from the ECB, that means that we're expecting a cut in January, a cut in March, a cut in April, maybe a cut in June as well. That's 4 consecutive cuts. That could take us pretty close to what Bloomberg Intelligence thinks is the neutral rate, which is a 2% deposit rate. We're at 3 right now. You could get down to 2 pretty fast into the beginning of the year, and that will sort of exhaust your cutting if that is about as far as you're going to go. And that is going to pose some real questions in terms of what is going to happen in terms of growth. Can there be more stimulation that could happen there from the ECB? But the other thing we need to watch out for, Guy, in the back half of the year is the monetary policy strategy review. This is going to be the second one that they've done in a couple of years. The last one they did was in 2021, and that was the first they'd done in about 2 decades. And in that policy review, they had a new definition of price stability, and that is when the ECB went from a 2% target to a kind of floating 2% target, i.e. you can overshoot and you can undershoot for periods of time, which is significant when you think about how much influence the ECB has over these markets and basically what goes into their thinking. So we're going to see what they have to say in terms of the updates going forward for what their strategy is going to be.
There seem to be many things that could knock the ECB off course, though, this year.
Yeah, listen, I think that one of the sort of structural issues that people are talking about, the hawks, are wages and sort of the services side of the economy. Those indications are actually pointing in the right direction. But when you look at energy, you look at this sort of Ukrainian gas transit deal, for example, that's 15 billion metric cubic meters of gas that's off the market overnight. Again, that was sort of expected and priced in, but that bears on energy prices. That bears on inflation. But I think the big one, Guy, as we've been talking about for a long time, is that trade war, not only with the United States, but if there's a trade war between China and the U.S., what happens to all that excess capacity in China? It comes right into the European market, and that's exactly what Klaus Knot has been warning about, that basically China could be exporting deflation to Europe if the trade war between the U.S. and China escalates.
Ollie, it's going to be an interesting year, a bumpy year potentially for the ECB. Thank you very much indeed. US futures currently pointing to a positive start for this new year. We're up by 0.7% for the S&P. Up next, The Brief. Danny Berger, Manus Cranny back together in New York. This is Bloomberg.